Hi there, and welcome to today's episode of the Investor Dictionary. Today we're looking at a term called tangible common equity. And what this is a measure of the company's capital which is used to evaluate specifically financial institutions, and that institution's ability to deal with potential losses. Tangible common equity is calculated by taking the company's book value, and from that you subtract the intangible assets. And intangible assets will be things like goodwill and preferred equity, and that will land you back with the real meat of what the company has to be able to deal with these potential losses. And this is particularly useful for evaluating companies that have large amounts of preferred stocks, and this is particularly of importance when you're wanting to value the stocks or value the underlying value of the asset, and that for that matter the true share value of the asset of institutions such as the US banks. Because recently US banks received, as you know, very large bailout packages from the federal government, and in exchange for those bailout packages, those banks had to issue a large number of shares of preferred stock to the federal government. So in other words, the federal government owns preferred stock of those banks, preferred stock otherwise known as preference shares. So the federal government owns the large chunks of preference shares of those banks, and to be able to get the tangible asset value, you would need to deduct that preferred stock or preference share value from the overall book value of the banking institution. And using the tangible common equity to calculate a capital adequacy ratio is one way of evaluating a bank's solvency, and is considered a conservative measure of a company's value. Another way to value a bank's solvency is to look at its Tier 1 capital, which consists of common shares, preferred shares, and retained earnings and deferred tax assets. But especially in this day and age where banks have been getting themselves into trouble and been needing bailout packages before deciding to purchase shares within a financial institution, it may very well be useful to you to use the more conservative approach of evaluating a bank's solvency rather than the more loose way, based on what we've been seeing going on before. And for instance, a company that has a high number of a large amount of preferred stock or a high number of preference shares in issue, one way of being able to improve the ratio of their tangible common equity is to do a conversion of the preferred stock or conversion of those preference shares into common shares. That's my take on the definition of tangible common equity. Please post your comments and questions down below, and click the thumbs up like button as well, and click that big red subscribe button as well, that way you can stay up to date on new videos as I post them on a week-to-week basis. Stay carved up for the win. I'll be seeing you next time. Cheers.